So, just like I predicted a couple weeks ago with my emerging market show about the total amount outstanding of dollar denominated debt from non banking financials in emerging markets, how it had exploded in the last 7 to 10 years since the global financial crisis of 2008. Emerging market central bankers have panicked with the most rate cuts now since the 2008 financial crisis. Just totally insane. There are multiple reasons for why this is being done. This was easily predictable if you knew about financial markets, if you knew about Keynesian economics, and if you knew that we're basically, and people don't like me saying basically, but we're towards the end game here because the central bankers do not know what else to do. They are basically doing the same things all around the globe. It's the same freaking playbook. And it's for a number of reasons why the central bankers are doing it. And it's going to backfire because they have dollar-denominated debt problems. Look at the dollar index today when we're doing this live stream show on Wednesday, September 4th, 2019. The dollar index is still above 98. It did not hold 99. It's at 98.66, which is still strong. And the 10-year U.S. bond yield is down to 1.452, which to me means that capital is leaving U.S. stock market, leaving emerging markets, especially emerging market stocks. I'll have more on that in a minute. And it is coming into the dollar and coming into U.S. Treasury market. There's actually, and credit to David Quinteri at Money GPS, he had this article. He sourced it in one of his videos, and I went and found it. It's from the Lipper Alpha Fund, which is a large mutual fund and ETF and index fund company, and they put out an article on September 1st, 2019 to clients. Investors are fleeing emerging market stock mutual funds during the third quarter. Lipper's emerging market funds peer group, including both mutual funds and ETFs, experienced net capital outflows. Remember, I was talking about this. If you go back and look over the many decades and look at all the past crises in emerging markets, whether it was the Mexican tequila crisis, the Asian tiger crisis, Argentina in the late 1990s or early 2000s, net capital outflows were involved. A lot of net capital outflows. So there were obviously other factors, but like the killing blow was the net capital outflows that basically destroyed the finances and hurt the currencies of these emerging market countries in past crises, normally with overborrowing or betting on currency movements and other dumb things. So this negative, I'll continue here with the article from the Lipper Alpha from September 1st by Patrick Keon. This negative net flow marked the 10th net outflow in the last 11 weeks for the peer group of emerging market mutual funds and ETFs, during which over almost $12 billion has left just this one mutual fund and ETFs group's coffers. As part of the slump, the emerging markets funds group suffered the worst weekly net outflow in its history. So this large mutual fund company, the worst weekly net capital outflow in its history. So lots of money leaving. And they began tracking this data in 1993. 4.1 billion left in just a week. The group has recorded a net negative outflow of 10.2 billion for the quarter. That's a lot of capital leaving some tiny countries. And this is why you get a combination of the central bankers in these emerging markets panicking, because they see that the Fed, the Fed has already done one rate cut, even though the U.S. technically, according to the official government data, is not in a recession, and that the European Central Bank has already done a lot of rate cuts and is negative and is announcing more QE. So you see emerging markets panicking now that if they don't start to cut rates, if they don't start to do that, and they're also doing QE, the emerging markets are going to be doing QE to try to counter the net capital outflows. Now, there are ways that emerging markets in the past have tried to stop net capital outflows. They've tried capital controls, and China has enormous capital controls, but that could just make things worse. So let me read this article that Zero Hedge put out yesterday. It says the global growth outlook is the lowest since the last financial crisis, and central banks, especially ones in emerging markets, have already started to cut interest rates to make sure growth doesn't collapse. The global macro data for manufacturing across large parts of South America, Europe, Asia, and the Middle East are reeling from a global structural slowdown. And we know this from the export data with Germany, with Taiwan, with South Korea, with Japan. The export data is not good, and it does not match the import data from China. It's probably never matched the import data from China, but it's getting more egregious. Amplified by the U.S. and China trade war, have triggered emerging central banks to cut rates by the most in a decade, reported Reuters. Emerging central banks took notice when major central banks, including the Fed and the European Central Bank, started to cut interest rates this summer, all in an attempt to lessen the impact of a global synchronized slowdown. Central banks across 37 emerging market economies recorded a net 14 interest rate cuts in August, the most since policymakers dropped rates to zero after the global financial crisis in 2008 and 2009. August marked the seventh straight month of net rate cuts, followed by a tightening cycle that ended in early 2019. July recorded a net 8 rate cuts. Cuts by Mexico and Thailand in August took markets by surprise. After 9 straight months of rate hikes in 2018, emerging market central banks battled the fallout from a firm dollar, increasing inflation, and weaker local currencies. They're battling, but the problem, guys, is the two main problems are the total amount of dollar-denominated debt. And so the rate cuts in emerging market central banks and QE by emerging market central banks does not help with the dollar-denominated debt, because if you're in Brazil, if you're the central bank of Brazil or the central bank of another emerging market country, you cannot print those dollars. Now, they may have dollar reserves, but normally there's so much dollar-denominated debt outstanding, and there's at least 11.8 trillion, according to the Bank of International Settlements, which I talked about a couple weeks ago in a report, from non-banking financials. So that the emerging market banks have more than that 11.8 trillion number. That's just non-banking financials. That's just governments, and that's private sector corporations, small businesses, personal consumer loans, etc. Maybe affluent people who were trying to bet on a weak dollar took out a large personal consumer loan. Rich people can do that. I know rich people here in the United States who tried taking out their mortgages in yen here in the United States. So far, it hasn't really worked out too well, I believe. But emerging markets are tempting to go from the same Keynesian playbook as all the other Keynesians or neo-Keynesians or mercantilists, neo-mercantilists. And it's not going to help with the dollar-denominated debt, and they're trying to also counter the net capital outflows. But the net capital outflows are not stopping, especially from emerging market stock markets. And that capital, you can see it from the ticker data, is coming into the U.S. Treasury market. And I got to give credit to Wolf Richter. I listened to his podcast from the last day or two, and he was talking about this bond trade, this long Treasury trade, betting on zero interest rate policy, or ZIRP, that Stanley Druckenmiller has been doing. And he is hypothesizing that people will not stay and hold the bonds to maturity, that eventually people will take their profits and dump those treasuries. So I don't know what would happen then. Most likely then the large U.S. banks would have to step in, the primary dealers would have to step in and put those treasuries, either if they couldn't dump them onto clients or dump them to pension funds or something, they'd have to step in maybe, and the Fed would have to reimburse them, or the banks would have to hold them to maturity. And they don't have to mark the losses down. Victor Sperandio has written articles about this. Or the Fed has to come in with QE then. But eventually, according to Wolf Richter, he says that all those bonds that people are making a lot of capital gains off of, with the yields going down in the 10-year, the value of the bond is going up, but the yields are going down. That's how bonds work. When the value of the bond goes up, the yield goes down, and when the yield goes up, the value of the bond goes down. So emerging markets are attempting to do very dumb things, and it's not going to work out for them because of net capital outflows, bottom line, because of net capital outflows and because of their dollar-denominated debt. If the emerging markets did not have dollar-denominated debt, they would be in much better shape. And China is one of the ones, the Brazilian government sold a lot of forward dollar swaps to attempt to bet on a weaker dollar in a very short amount of time. I think like a 2-year time span in like 2013 to 2015 or something like that. I can't remember the exact dates. I was reading the article last night. I'll talk about this in another show because this is very sophisticated. I'll have to try to explain this to you guys It's very complicated. I'll have to do a whole nother show on this, explaining why the Bank of Jinzhou, why they're not getting help with their dollar debt. Confirms Kyle, in my opinion, confirms Kyle Bass's thesis that China is either out of dollars, or they have a lot less reserves, or they're strictly rationing the little dollars that they have left. And I'll talk about all the crazy derivatives trades that the Chinese government has been ordering the Chinese banks to do. It's pretty nuts, the derivatives trades. It's a very sophisticated derivatives trades that the Chinese government has ordered the Chinese banks, both onshore and offshore, to do, and the amount of these trades has been increasing for years. And they were betting, like other emerging markets were doing this too. Brazil was one of the worst ones, and Brazil was betting on a weaker dollar. And as you've seen with the dollar rally, whether it's a trade-weighted dollar index or the dollar index, the dollar has not weakened like the emerging markets were hoping for. And Brazil, because they sold a ridiculous amount of these derivatives, they sold a ton of forward dollar swaps, that their currency, they were just burdened with extra liabilities and leverage. And there was a leak from the Brazilian central bank about this, I think last year, that leaked to Bloomberg. Someone inside the Brazilian central bank leaked this stuff. And the currency in Brazil, I think about 4 or 5 years ago, it lost over 50% against the dollar in a very short amount of time. I think under 3 years. So just more craziness, guys. But this was my point: is if you're paying attention and you understand Austrian School of Economics, and you understand the debt problem, and you understand the total amount of debt outstanding, and how nothing was learned from 2008, even more debt was issued, pervasive throughout society. And then on top of that, the dollar-denominated debt, especially in emerging markets that were gambling on a weak dollar, this was all predictable. And the dollar has not gone weak. The dollar has gotten strong. All of this stuff was predictable. And emerging markets are not, the central bankers of emerging markets may be able to help with some of the stuff, maybe some of the net capital outflows. My educated guess would be that some of these emerging market central bankers now will start to buy exchange traded funds. I hope I'm wrong about this, but they're going to start copying Japan too. You're going to see emerging market central bankers, because they're going to be worried about stock market collapses, they're probably going to start buying emerging market, their exchange traded funds, maybe even shares of companies. And so now all of these central banks, guys, are turning into hedge funds. The ones that weren't hedge funds in the last 4 or 5 years are now going to be hedge funds. So these central banks are hedge funds. And there's just these crazy disclosures. I found a Bloomberg article from last month where this article writer from Bloomberg went through speeches from one of the central bankers in Australia, the Reserve Bank of Australia, and the central banker in Australia was bragging about how they were taking their reserves. They were taking like Australian dollars, and then they were doing sophisticated currency trades and betting on yen and doing other leverage carry trades and other crazy stuff. Okay, the central bankers in one country should not be doing crazy bets, crazy derivatives bets, crazy currency trades, that type of leverage and that type of bets. And by the way, they're not hedged. These central bankers are unhedged. So they're hedge funds, but they're not hedged, and they're using way too much leverage. The new normal sucks. And this is why RR says gold has no negative rates. And this is why gold is doing well, because money is coming into U.S. Treasuries and money is going into gold and silver. Yes, globally, Isabella, most of the yield curves are inverted. And that's why there's also a lot of flight capital that's come in from emerging markets, the European Union, and China here into the United States, into the Treasury market. And even there's net capital outflows out of U.S. stocks now, and that's going into the dollar, and that's going into U.S. Treasuries. And there's also, there has been for over a year now net selling from insiders of large U.S. companies, and I'm sure those guys are going to cash Treasuries and gold too. Although I doubt you will have large corporate CEOs admit on a public interview on CNBC or Bloomberg that they are buying a lot of gold with their own money. Why do I never mention Bitcoin? Because Anytime I mention Bitcoin, even for 2 seconds, Bill Holter then claims I'm a crypto pumper. But yes, flight capital is leaving China. Bitcoin is being used as an intermediary. This is not financial advice, but I've told people that if they want to diversify, protect themselves, they should hold some cash US dollars in case there's a stock market crash. They should have physical gold and silver for savings, insurance, and wealth preservation. And then also they should speculate maybe on a little bit of Bitcoin. I've been saying this for a very long time. Anytime I mention Bitcoin, guys, his trolls send me emails and nasty comments in the comment section. He has trolls that make up fake names and send me really, really nasty messages and emails all the time. It's mostly Facebook, it's mostly YouTube comments. Thank you for the super chat, Jay. €5, appreciate it. What length U.S. Treasury should you buy to preserve the worth of your money? Thank you, Donald, for the super chat, too. Didn't see you there. I didn't check the super chat until a second ago. I've been talking about Bitcoin for a while, but the gold community, I get emails from people in the gold community telling me I'm a crypto pumper because I say anything nice about Bitcoin. That's how ridiculous a lot of people in the gold community are. A lot of people in the gold community, either you like gold and silver and nothing else, or you're not part of the team. They start talking shit on you. There is no diversification allowed. Some people in the gold community, if you own gold and silver stocks, you're looked at bad too. For U.S. Treasuries, Jay, that's a short-term trade. I do not think that they are a good preserver of capital. If U.S. Treasuries, Jay, if they go to zero interest rate policy or negative interest rate policy, the only thing you're going to get, you're not going to get any type of income, no yield, or worse, if it goes negative. You're only going to get capital gains. And even then, if you hold the bonds to maturity, you're going to be a sucker because they're going to the value of the bond, you're going to have a nominal gain that you're going to have to pay taxes on, and the value of the bond in real terms, the longer you hold that bond, is going to be inflated away. So if you want to do a trade, if you want to bet on, follow Stanley Druckenmiller on bet on the 10-year treasury, this is not financial advice, just my opinion. If you want to bet on the 10-year treasury going from, let me look at the exact yield, it's 1.456 down to 0. There's capital gains you can make. And for maybe the next year or two, you can make capital gains on that, but I would not want to be holding that bond long term. Just look, these governments have talked about issuing, Japan has talked about it too. The US has talked about it. Donald Trump just talked about it last month. They've talked about issuing 50 and 100-year bonds. Okay, the value of those bonds, the government will pay out nominal yield if they have to. On a nominal, the government, the value of the bond will look okay. On a real terms, with a real inflation rate, with the value of the dollar, the purchasing power, you're going to get destroyed. Now, it's not going to be as quickly as what happened in Argentina, how like 3 or 4 years later from them issuing the 100-year bond, the bond is already down more than 55% in value. It's not going to happen probably that quickly with Japan or the US, but it's an eventuality that those bonds will lose value. Okay, gold, silver, good gold and silver companies. If you need income, and everyone needs income, again, this is not financial advice. I would not be looking for income in the stock market or in the bond market. The bond market and the stock market and the municipal bond market, those are not good sources of income. They are very dangerous. These bond markets are not pricing in any of the risk, any of the inflation risk, any of the risk of the local government or the federal government defaulting on the principal or inflating the value of the currency. They're not properly pricing in any of the risk. Look at the yields in the European Union for Italian government debt and Greek government debt. It's just ridiculous. It's not pricing in any of the risk, in my opinion. The central bankers, with their distortive policies, their interventionist policies, have broken the bond markets. They've broken the government bond market. They're breaking the corporate bond market. The corporate bond markets, especially in Europe and the US, are getting just ridiculous. There's rental property opportunities here in the United States, even if you're a foreigner. Talk to my friend Jason Hartman. He routinely has foreign investors, and he sets them up with turnkey cash flow rental properties. Teaches people how to do it with education. He's not paying me any money to do this. He's just one of the few people out there that actually sets up this service for people. He has educational materials. He has a free podcast that teaches people how to do this. And then he also sells prepackaged rental properties all over the United States that cash flow positive for $800 to $2,000 a month. If I had more money coming in, if my small business and my podcast was more successful, maybe in a couple months it will be, maybe in a year it will be. Thank you, though, to my almost 150 Patreon account contributors and my almost a dozen now PayPal monthly contributors. Thank you very much, and thank you very much to the people who contribute once in a while, who just send me a tip once in a while. I do have to get the Bitcoin thing fixed on my website, but I've been so busy making content, guys. I almost made 3 videos yesterday. Just an enormous, my voice was going. I almost did 3 videos. I have Zero Hedge, to my knowledge. I have not seen the article yet. Zero Hedge is still not covering the Bank of Jinzhou basically defaulting on their dollar bonds. I think it is a very big deal. I think it proves that Kyle Bass's thesis is almost entirely correct, and I will be talking about that very shortly, probably later today. It's going to be difficult for me to explain this stuff because there's a lot of derivatives trades involved. So I will do my best, but then I will tell you if you're sophisticated and you want to learn more about this and why China has screwed things up very, very royally, then I will explain it. But China has made some really dumb bets. Very, very dumb bets with a lot of leverage. They went all in shorting the dollar and were hoping for a weak dollar, and things have not worked out. And they're losing, in my opinion, they don't have the dollar reserves to fund all their programs, to bail out their banks. There's not enough dollars available to support all the things that they have to support. So they're going to, either they're out of dollars entirely or they're on very strict rations. Eric asks if I think, do I see rent controls working? I'm not sure how much politicians here in the United States will increase rent controls. It's a realistic possibility because it was discussed doing it countrywide in the 1970s. So thank you for the super chat, Kevin. It's a possibility. This is why it is dangerous as to only own rental properties. I know people out there that are very affluent and they own a lot of rental properties all over the U.S. and they say they're diversified. And some of these people only own rental properties in a couple cities and a couple states, and I don't consider that diversified, in my opinion. So there's a realistic possibility of rent controls. There's what's also more likely, Kevin, is that these stupid politicians in some cities and states are going to jack up the property taxes so much. I was listening to Aaron Clarey talk on his YouTube channel last night. I watched an old video, and he had rental properties in Minneapolis, Minnesota when he was a young adult, and the city of Minneapolis jacked up property taxes, I think 3 times in a 7-year span, and they totally ruined the positive cash flow of his rental properties. So that's always a risk. There's a risk in everything. There's risk with gold and silver here in the United States of a windfall profits tax or confiscation. There's a risk if you own physical gold in China of confiscation. The Chinese government does not let people leave the mainland China with physical gold bullion, and they have tracked all physical gold purchases now. You have to buy, if you go live in mainland China and you go and buy physical gold bullion at a retail bullion shop, you have to buy with a credit card, which means then that they have your address and they know that you've been buying a lot of gold. They can track the amount through their social credit score. Everything's tallied. So there's risk. There is no perfect solution, unfortunately, guys, anymore. Again, not financial advice, but this is why diversification is important, in my opinion. There's risk with everything now. And this is because the governments are doing and central banks all over the globe are doing really, really dumb and desperate things. Very, very dumb, very, very extreme, very, very desperate things. And they're going to try to change the rules to make sure the governments get their funding. And that could be seizing assets, windfall profits taxes, wage and price controls. We could see all these things put in. I'm sorry it's dystopian, but that's the reality of the situation, and that's why I have so many Patreon account contributors now. Because I'm laying out the facts for you and how to deal with this bullshit. RR says governments tax people too much. Exactly, but a lot of people are conditioned now to just shrug their shoulders and not complain anymore. Isabella, I agree. The Chinese are losing control. I will explain this in a video. Hopefully later today, we'll see how I feel. It's going to take a lot of effort on my part to explain this sophisticated trade that the Chinese government has been doing with derivatives. Because Kyle Bass has been posting articles on his Twitter for months, and I've been reading them and putting the pieces together. What is a low tax area now? RR could turn into a high tax area with the next election. Or if the pension fund in that city or state is underfunded. Okay, well, I think that's it for this short video. I have other articles here about negative interest rates from Jim Bianco. Just put out an article yesterday for Bloomberg, an op-ed about how negative interest rates threaten the entire financial system, but the central bankers will probably stupidly do it anyway and ignore him. And the guy from Big Short, Michael Burry, he is betting on index funds blowing up the stock market because they trade on momentum. So I think we could see, this is a prediction. I don't know exactly what time frame, but I think the next course of action of stupidity for emerging market central bankers will be to try to counter these net capital outflows out of emerging market stocks and emerging market mutual funds and emerging market ETFs. And these emerging market central banks, now that they're cutting rates rapidly and they're either restarting or doing QE now, I think the next course of action probably will be for these other emerging market central banks, if they have not already done so, to start copying the Bank of Switzerland, which is basically a stock hedge fund now. They're a technology and stock hedge fund. And then other central banks like the Bank of Japan. Bank of Japan owns, I think, 70%. It's about 70% of all Japanese stock market exchange traded funds. Just freaking insane. The insanity continues. This is why I sleep better at night, why I have exposure to quality gold and silver companies with a couple speculations, and also this is me personally, not financial advice, why I own physical gold and silver metal and a little bit of Bitcoin. This is why I sleep better at night. If I had more money coming in, it would also be in some rental properties for cash flow. Okay, guys, well, that's it for right now, and there may be more content coming later today. You'll just have to check back. I recommend, guys, if you're not getting the notifications for the live streams, just check back every day or two. And from now on, because I'm getting positive results here with the growth of my channel and more Patreon account contributors and more PayPal contributors, all those things are finally starting to really trend in the right direction finally. I recommend, if you're not getting the live notifications and you're subscribed to my channel, check every day or two and there should be a new video or new interview out. My hustle's finally paying off after 3 or 4 months of hard work. I think I've had one day off in the last 3 or 4 months. Okay, bye for now.